Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called The Smashed Aussie Economy. After the inflation and GDP numbers came out yesterday, we thought it'd be worth a look at the emerging crisis in the Australian economy. We were going to run another show, but that can wait until next week. On the agenda, we'll look at the GDP and how it's fading fast. Next, we'll explore peaked consumer income and the wealth squeeze. Then we'll delve into current fiscal and monetary policy and the outlook for 2023 and beyond. As always, at the end, we'll explore the investment implications. Today, as always, I want to introduce the co-founder and chief investment officer at Nucleus Wealth, Damien Klassen. Welcome.
Thanks, Sam. How you going?
Hey, Damo. Today, we're also joined by the other star of the show, David Llewellyn-Smith, who's Nucleus Wealth's chief strategist and co-founder also. Dave, welcome.
G'day, thanks, Sam.
Thanks, guys. It's great to be here. My name's Sam Kerr. I'm the senior financial advisor at Nucleus Wealth. And for those listeners that don't know, Nucleus Wealth is an Australian and global active and passive investment manager. We're a quality and value investment house and use the insights shared in this podcast to construct and manage our active portfolios. We're also the first to offer passive direct indexing in Australia, which has been labelled ETFs 2.0. These are currently a huge and growing segment of the market in the US and Europe. The benefit of direct indexing is you directly hold each stock in your professionally managed account as opposed to an ETF where you only have one fixed security. This allows you to customize your investment with our off-the-shelf and bespoke ethical, sector, and asset class screens and tilts, and we have around 60 to choose from. Just a reminder, the information in this podcast is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact, and you can book a call with me. If you enjoy our content and want us to continue to make more, please subscribe to our YouTube channel and click the bell below to make sure you don't miss out. We are live every Thursday at 12:30 Sydney Melbourne time, so jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform as our show is available on all the majors. And if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So now we've got those intros out of the way. Damo, I'll hand over you to get us started.
Yeah, look, as you alluded, we wanted to have a bit of run through sectors. Originally, we wanted to run through sectors and talk about, which sectors perform at which point of the cycle and go into that type of detail for this week. But we pushed that one out to next week, just given we had both inflation and GDP come out yesterday in Australia, and both of them surprised to the downside and are I think, emblematic of some of the issues we've been speaking about. And so we just thought we'd go into that in a bit more detail, just to confirm what we've been seeing and just discuss what the implications are. So, with that, I guess we probably should start with the whole GDP side, Dave. It's flat domestic final demand and per capita back to the Aussie special of rising in absolute terms, but falling in a per capita terms.
Well, not even rising. Rising in GDP terms, yes.
Yes. Yeah. So the government of the day can say, look, GDP is going up. And then
that's right.
On a per person basis, everything's going back.
0.5 on the quarter and 2.7 over the year, but in per capita terms, flat. In the September quarter was flat, and I think it went down in the fourth quarter. But in terms of domestic final demand, it's considerably worse than that, and that's kind of the real economy that people live in.
And so, the big picture difference really is the exports for coal and exports for gas, really, isn't it?
Yeah,
it's a difference. Your big difference between your GDP and then your final demand.
Yeah.
And I don't know about you personally, Dave, but I think for most people they're a net negative when gas prices go up. it's a net negative for them. It's not a net positive. And it's not, while GDP might show that things are better because we've got all these exports overseas, most of that money is going to foreign companies anyway. And so the actual Australian citizens don't actually benefit from that while GDP does.
Well, not in its entirety, but certainly on the East Coast. And it's definitely the case that GDP was driven by net exports in December, up by 1.1%, whereas domestic final demand was flat. And of course, in the terms that really matter to everybody, which is per capita, they fell. So the standard of living fell quite sharply in the December quarter for everybody. So, that's a pretty ordinary composition, particularly when you note that we had nearly record high terms of trade in that quarter as well. And listeners may recall that the terms of trade is the value of exports divided by the value of your imports, and so it's a measure basically of the sort of national wage packet. And when it goes up, everybody is supposed to see higher wages and rising income. But at the moment, owing to some of the things you described with the energy shock, very poor policy formulation for extractive industries, especially gas, all sorts of oligopolistic problems and mass immigration squashing wages, our high terms of trade now results in falling standards of living for households. So that's.
But some of the companies that have invested in Australia, they at least they don't have to worry about sovereign risk, David.
No,
that's the key.
That's right. There is risk to the sovereign, but no, they don't have to worry about sovereign risk. So it was, these are very broad brushstroke measures of GDP, but they were very poor for Australians, and moreover, very poor for markets. It's clear that GDP is slowing very fast. 6 months ago, the Australian economy was 6 months behind the rest of the developed market world in terms of its business cycle. Right now, it looks like it's ahead of it on the way down. So we've closed that gap, catching down to the US and Europe very quickly, as Europe's actually rebounded a little, and so has the US in the last few months. But we now look like the leading developed market economy headed for trouble.
And that savings rate is probably one of the big ones for that. That's for the next
it is. So, the real driver of all this is there's a massive consumer income and wealth squeeze underway, and that was captured in a huge fall in real disposable income in the December quarter, down by 2.2% in the quarter. So, you annualize that, and your standard of living has fallen by 10% over the year, and in annualized terms.
Yeah.
Which is
what we mean by real is inflation adjusted. So a lot of that is high inflation versus low wages.
That's right. Basically, what's happening is there are some wage gains in the economy, but they're being swamped by rising costs and interest rate hikes. And so real disposing income is getting absolutely walloped.
Yeah. So, realistically, though, the wage, if we were seeing the current rate of wage increases and we had 2.5% inflation, you'd be like, maybe they've got a slight bias towards tightening, but not really. Like, it's not like the wages aren't so high that you'd be worried about it in any other circumstance.
No, look, if we go back 3 years pre-COVID, wages are now at 3.4, is it, on the WPI? I can't remember. They're mid-threes. And the RBA would have been cracking the champagne corks and saying, this is brilliant. We're finally getting some sustainable wage inflation, and we'll be able to finally get inflation up into our 2 to 3% bracket. That 3.5, 4 level is pretty much what you want. Yeah.
So you basically 2.5% inflation plus another 1% productivity growth gives you 3.5%.
Exactly right. Yeah. And so that gets everybody going forward. And so the RBA would have been, patting itself on the back. But sadly, with rampant inflation and very low wage growth that appears to have peaked and is probably going to fall away from here, means that real disposable income and this squeeze is not over. It's going to continue. So, as you mentioned, that household savings ratio is, kind of representative of that. Households have fallen basically below what is normally considered the equilibrium savings rate, which is generally sort of 5 or 6%. And that's telling you they're drawing down their savings now.
And part of that, though, as well, like for anyone who can't see this graph, we've sort of got this chart over the last almost 10 years of the household savings ratio, sort of showing that it's started in 2014 at 7.5%-ish, and sort of gradually worked its way down and spent most of the decade at sort of 5%. And then as COVID hit, it rocketed up to over 20% as all these transfers went from government. And this is a global phenomenon as well, particularly in developed markets, global developed market phenomenon. Is it rocketed up to sort of 20%, and then since then households have been running that savings ratio down, and that's been a lot of the argument why inflation's been higher, and a lot of the argument as to why growth can continue on is because consumers still have all this spare cash that they can apply to keep on buying things, even though wage growth might be weak and inflation might be high. They're saved because this savings ratio is there. And this chart's just showing you that it's run out. Like it's
no. This is only the ratio that the stock of savings hasn't run out. That's still
right. Yeah, sorry, the rate.
Yeah. So
the accumulation of savings.
So that's stopped, and so consumers are running down what from savings they would normally have to support consumption. There is still this stock of, pick a number, 200 to 300 billion of excess savings that economists like to say. But, is it excess or isn't it really depends on your context. And I would argue that in the middle of a consumer income and wealth squeeze, those savings are not likely to be run down overly, unless forcibly, not in discretionary terms, because you're going to have a conservative consumer. But that cushion is there, so it should help at the margin. So then we have house prices down, nearly 10%, about $1 trillion in wealth gone as well, and so Australian households are taking a beating, is what we're seeing, and that's really the primary driver of what we saw in very weak domestic demand, and the other component of that, which I haven't charted here, but to give you a quick brief, is private investment is also quite weak. That's in both dwelling construction and more broadly, as businesses have already, I guess, sensed this weakness coming out of households, and so some of those investment plans are also weakening, and so this is all pretty typical of heading towards kind of recessionary conditions, which as I said, I think we basically are in a per capita recession already. And, this was the December quarter, remember? So we'll see what comes up next. But it's not looking too promising. So how far does this thing get? The central issue with it is, wages just aren't strong enough relative to price pressures, so inflation. And that appears like it's about to get worse, at least on the wages side. There was evidence of easing price pressures in the GDP thing, which is good news. And we saw that in yesterday's monthly inflation read as well from the ABS. So inflation's starting to come down too, but I fear wage growth will also peak and fall away. Our last wage price index was materially lower than expected. And, arguably we're seeing kind of weakness on some supply measures of the labour market more quickly than the economy is actually slowed. And the reason why I put up here is quite simply we've got a mass immigration supply bomb going off across the nation, where you can see this chart here where we're basically going to have almost 500,000 extra workers in Australia this year versus last as the borders reopen. And a lot of that is Students and temporary migrants easily exploited labour, which is very dependent upon the employer for sponsorship. And we all know from the last cycle what that means in terms of abuse of workers, wage theft, falling conditions, and weakening wages. So, I think that's really what's underpinning the weakening wage growth circumstance. And then you can add in, as I said, that businesses are starting to sense that households are softening, and job ads have peaked and are starting to fall. And there's a nice chart here showing that they've already fallen far enough to get the jobs rate back up to sort of 4.5%. And I don't think that's the end of it. I'll probably keep falling job ads going ahead, because weak wages is weak demand, especially if you're getting whacked with, huge nominal price increases. So, I'd expect weak final domestic demand to continue and probably deteriorate. We'll come back to how much it will deteriorate. That's really going to be up to the RBA and fiscal authorities. But first, I want to quickly go through China and its reopening, because there's, a fair narrative out there at the moment, jumping up and down saying China's back and China will save us. And I'm afraid that is not going to happen much in Australia's case this time. As mentioned, all of these nasty income shocks are happening amid a record terms of trade, which really is, for the egghead economist, very shocking indeed. If you look at our chart here, you'll see there are two mighty peaks in the terms of trade. The first one being in 2008, when iron ore and coal and LNG were all going gangbusters. And you may recall that we had the hottest economy anyone could ever remember at the same time then, and we had tearaway wage rises, rising interest.
Aussie dollar at $1.10.
Aussie dollar going nuts. Oh no, that was afterwards. But the Aussie dollar, I think, got well above 90. Booming GDP, booming jobs market, booming income growth, booming house prices, booming everything. Everyone was galloping forwards. And it was largely driven by this chart with the terms of trade, because there was just, the nation had this massive pay rise, basically, through, the China boom and our booming economy, commodities. And as you can see, then it crashed as China kind of decided to restructure its economy, and we went through 10 years of falling income and weak inflation. And then COVID unleashed this incredible spike in the terms of trade again, and an unbelievable influx of income again. However, it has not resulted in the same type of economy at all, for a number of different reasons. A lot of the mechanisms that used to distribute that commodity income from the miners into the community are broken. There used to be three major mechanisms. One was through big flows of tax, corporate tax into the budget, which would be recycled as household tax cuts. And we've long ago lost most of those to tax hikes, because the budget expenditures have simply risen alongside it, and there's no surplus there to recycle.
Well, that's one part, but the other part is this second one's been a lot more gas driven and oil driven. Okay, sorry.
That's right. And the second one, the second mechanism that used to drive the income into the economy was wages, because higher commodity prices would drive huge investment into new capacity. But these days, the miners are rightly sceptical of the Chinese growth future, and other factors, ESG and others, climate, etc., that mean they simply don't invest into high prices anymore. They have sufficient capacity. In fact, they have a lot of idle capacity, which means there's no transmission into the real economy for that income, and so wages don't rise.
Yeah, and so can I just expand on that point a little bit? So the idea behind that is that sort of 2009 sort of boom thing that you saw in there was all about all the iron ore miners were rapidly trying to get as much extra capacity on as they possibly could. All the coal was trying to get extra capacity. Like there was just sector by sector you go through, and everyone was we had the sort of going from where we were on the league chart to second overall in terms of the amount of gas exports. Like it's one of the biggest ever gas expansion of gas, like all at the same time was happening over that period. And then, and that's why we spoke about it. We've spoken about recently about it not being a commodity super cycle, despite what people are saying. We're saying it's a prices super cycle because prices have boomed, but in a real commodity super cycle, you actually see volumes boom as well. And so this has actually been about constrained supply, slightly above average demand and constrained supply, creating these massive price booms. I'll exclude lithium and some of those ones because they are genuine super cycles. But in most commodities, what you haven't seen is that mixture of such huge increases in demand that supply just can't keep up. This time has been a completely different one. It's been about the lack of supply or reduced supply in the face of just sort of mildly better demand rather than sort of this galloping demand that sort of drives a huge super cycle. And so that's why, as Dave said, companies are looking at that and going, well, do I want to go out and double the size of my mine just to sort of chase slightly above average demand or above average demand in coal because Russia's gas to Europe's been cut off? And so it's actually just more of a structural issue in terms of transition rather than like a fundamental, everything's going to be higher in the future.
So then we have, of course, the gas problem on the East Coast, where you have a cartel that is importing unbelievably high prices from elsewhere and passing them into energy costs for everybody, and so that export boom has actually turned into a massive domestic inflation problem and bust, which is showing up in despite having this incredible kind of pay rise for the national income, we're running these enormous primary income deficits, which actually looks like we've done the opposite. And we were running trade surpluses for the last few years, and they've crashed into deficit as well, and that's all gas cartel related. So all these factors come together basically to mean that this is a bizarrely profitless terms of trade boom, and of course it's going to fall away because it's so high. I mean, we've already seen coal halve, we've seen gas fall even more than that, like 70-80%, and that will register in this table. Yes, there's been some offsets with iron ore and coking coal and things, but it's clearly going to continue to fall. Now there'll be some upside for the economy on that with cheaper energy, but the net result will because it's overall will actually be negative for income going forward. So this makes we've taken almost the perfect conditions for national boom, butchered them completely with terrible policy, and now we're going to see that boom go bust. So I'm sure you can imagine where that's going. So
the other thing worth on the China status is, so China's obviously opened itself up to the rest of the world now. Ideally, there is a bit of a narrative going on. We haven't looked at any charts on it, but a bit of narrative going on. Well, they're going to resume this whole property boom and get out and build more property. There's going to be this massive consumption boom, and that's going to drive China massively higher, and they're going to need lots more iron ore and coal and copper and all these other things, and that's going to help save Australia as well, just as it did coming out of the financial crisis. And I guess the response to that for me is, well, first of all, China never really locked down as much as what other countries did, and they've had a few ins and outs already of lockdown. So you haven't actually had the same haven't got the same conditions that we saw in Australia coming out of the lockdown or the US coming out of their lockdowns. China's already sort of come out of lockdowns a couple of times, and so one, it's not going to be as great. Secondly, property, there's no signs that property is back on in terms of it. They were trying to squash property in terms of limiting how much debt they could take. They've stopped the part about limiting the debt, but they haven't got out to policies to actually try and drive property higher. And so, to date, we really haven't seen any signs that the whole property trade is going to be back on, and they're going to go back and double the amount of property building they're doing at the moment. If anything, it's more about actually sort of just preventing it from falling over completely, rather than going out and trying to reignite the boom. And then the Chinese consumer, Chinese policies are very much based around giving support to companies rather than giving support to consumers. So in most other countries, we saw that savings chart for Australia. That was all about governments transferring money directly to consumers through a number of different mechanisms, and that's what we saw in most other countries in that lockdowns. China, we didn't see it to anywhere near the same extent, and so we're not expecting as much of a consumption boom for China, and also there's the Chinese tourism's back on. So Chinese tourism is a key one. Australia may benefit a bit from that, but there's obviously been a lot of negative press in China about Australia, and we probably won't benefit as much as a lot of other countries from sort of the return of the Chinese tourists.
Yeah, so China won't save us, in short. So that brings us to we'll start to look forward here and see how much worse this circumstance will get for the economy. And for that, I really look to the fiscal and monetary impulses, and to see whether they're withdrawing or adding to credit and liquidity and spending. And the easiest way to encapsulate them all is in Goldman's Financial Conditions Index, and I can tell you that basically both monetary and fiscal impulses are quite negative. And you can see on this chart here, which just compares the major economies around the world, that Australia has undergone one of the major tightenings globally in the last 12 months, and it is ongoing. So I'm not seeing any positive spur from either monetary or fiscal impulses in the very near future anyway. We have to start asking the question at this point, because the economy is deteriorating so fast, when are people going to pivot? When is the RBA going to pivot? We're basically already in per capita recession. However, we've still got, the monthly inflation figure was 7.4, I think, or 7.2. The composition of that was the sort of global goods inflation bust that we've seen play out in the US over the last 6 or 8 months finally arrived here, and goods were deflated sharply, but services inflation has taken hold a little, and so the RBA, despite the fact that we're seeing all of this weakness, is going to be looking at that and worrying rather pointlessly about wages, as we've described, in terms of this turning into any ongoing wage push cycle. But there are still some hot inflation numbers in various parts of the economy, and I think they are kind of committed to at least one more hike.
And it's pretty hard to turn that ship around as well. Like, it's if they've made the view that this is what's happening. Yeah, I mean, your month before you
look. The RBA is a terrible forecaster, but the one thing that you have to say for them over the years is they do follow the data. Like, they don't stand on ceremony. When they're wrong, they just pivot and move. I think, however, this time they will deliver another hike next week. If I were them, I'd be backing off real fast about further hikes. Even though that those some areas of the economy are still really overheated in terms of price hikes, because dead ahead we've still got our fixed rate mortgage cliff, which is going to land on the consumer again and again on discretionary income and again on discretionary consumption. And so, what we've seen in these dynamics as early as December quarter are all, rapidly running underneath a falling anvil that is already in place. And I just think that the December quarter numbers really tell you that, the economy's trying to limp out of the way of this anvil, and it's not going to succeed. It's going to land on it where it is most vulnerable. And so, will the RBA see it that way? I suspect they will hike next week, and that may be it. Because they are pretty good at turning when they're wrong, and they are wrong. So
they haven't worked that out yet. And it's ironic with this whole talk about this wages part. So wages are low, and they've sort of they've been talking about that's a good thing, as he said. They're trying to keep wage inflation from breaking out, which has never actually happened. But this whole lots, we spoke about it, lots 500,000 more people coming in, helping keep wages low, but also at the same time pushing rents up, which is a key part of the CPI. Yeah. You sort of just a minute, if you're fighting to try and keep rents from rising because of the students who are flooding in who are pushing wages down, and there's an argument there once you follow it through is actually, well, just a minute, why are you raising rents to well, and why are you bringing all these extra students to cause?
Well, there's a supply side problem, isn't it? And what you're actually doing is preventing any supply side expansion.
Yes.
By tightening, and so. And yes, rents are an issue, as are the electricity price rises and other things. But domestic demand is I won't say in free fall, but only because I'm being dramatic.
Well, and the thing is, we had a really bad retail sales in December, and then a little bit better in January. And I think for a lot of those, you average the two, and you're
not in volume terms.
No volume terms. Terrible. Shocking. Yeah.
So
this is in price terms. Yes.
Yeah. So no.
So, but actually, let me just define what we mean by that. Because inflation's so high, if you're saying, I sold 5% more this year than what I sold last year, you actually probably sold 2 or 3% less actual goods. It's just that the prices are up 8%, and so therefore you can say you're
and the point is that GDP measures volumes, not prices.
Yeah. So, but also as well, people out there care about volumes, not prices. Like if you can, if you can buy, less food this year than what you bought last year, or what you bought this time, or whatever it is, or less goods, the fact that you paid more for it is of no comfort to you.
So my best guess is they do one more and then pause, but I could be wrong. There are some very august economists calling 4.1 as the terminal rate. I think if they go there, we are absolutely dead certain to go into real recession. And I could be wrong. Maybe that's what it will actually take to crush the price rises out of the very oligopolistic Australian economy. Who are all profiteering their asses off low wages and profit-led inflation at the moment. And so, maybe the RBA does have to go that far. All I'm saying is that if they do, I think we're almost dead certain to have a proper recession later in the year, which, on both counts, quite frankly, if they go once more and stop, or they go a couple more and stop, I think with the fixed rate cliff still to come, that the RBA is going to be forced to cut earlier and deeper than other developed markets later this year. I expect the Chinese rebound to disappoint, of course, and then I'm also expecting US recession some point this year, mid-year or a second half, whatever it is. I expect the equity market to fall further, house prices to fall further.
Profits to be downgraded by at least 5%,
and
probably up to 15%.
Yeah, well, you got weak demand now. Confronting falling inflation, and so margins are going to get walloped in Australia, especially, but in the US as well, and everywhere else. And then you've got Europe. It's got a real stagflation problem. The ECB's running wild there. So I think we're more or less on track for a global recession at some point this year. These things are very hard to time precisely. But you put all that together, I think Australia is really in a bit of trouble. And what we did have this terrific cushion between us and everyone else. And I actually think we've managed this so badly that we've hurtled straight past everybody, and we're now leading developed markets into a crash. So
part of this is the structure of our interest rate market as well.
It is.
So
it is. But the RBA, look, I mean, in the end, it may prove that the RBA has been right, and we had to go into recession, to squash this inflation, this supply side, largely supply side inflation, and it's just dealing with an oligopolistic economy that.
And what David means by that,
the only way to manage it was to crush demand.
Yeah. And what David means by that is there's this issue out there in terms of if you have a company that say you're a grocery store and you don't really have any other competitors. You've got one other big competitor, and you can raise your prices by 8%, and if they raise their prices by 8%, and your wages grew by 4%, and your costs grew by 5%, you've actually expanded your margins. So you've taken it and you're actually making a bigger profit than what you did before. Now, if there's lots of grocery stores, somebody out there starts pushing the prices down, and eventually you have to follow suit, because otherwise you lose market share. If there's only one or two of you and you're all pretty disciplined and you just all keep holding those price lines, then you make higher margins. That's the sort of, if you, in a monopoly sense, you can do it, and an oligopoly is effectively a bit like a tacit one where people just, nobody rocks the boat, and you all make lots of money. The problem, and so that's this. What David's talking about is Australia has a lot of different industries where we've allowed all this consolidation, and we've been left with a couple of just very big individual players in it, whether it's sort of banking or retail or shopping stores or other different markets. And so we're very at risk to this. And what David's saying is, well, if the only way to get it is actually to force us into recession, so that people literally can't afford that 8% increase anymore, and they buy less, and eventually the supermarkets do have to put their prices down, and eventually the banks do have to actually start raising their deposit rates to sort of chase this. And because there's just no other way to force, no other way, excluding having an industrial policy or an ACCC that sort of gets out and chases these things.
Yeah.
And the problem is a lot of that, the gate's already closed. Like, you should have done it. You shouldn't have allowed such market dominance in the first place. It's very hard to change it once you have allowed that market dominance.
In other words, it's gaming-led inflation.
So, profit level. We've had a few reports out there, and the unions are obviously chasing that report this week.
Absolutely, 100%.
Yeah, and there's a fair bit of truth to that.
So the outlook then for sort of Australian assets, I think, is further deflation in pretty much everything other than bonds. I think there's a bid coming in there, and the Australian dollar has been weak for a while, and I think it's going to ebb and flow with this debate around when the US when and if the US slides into recession versus when and if China recovers, and the Australian dollar is going to bounce around with that. But I think the end result is that it's weak again on a weakening domestic economy, basically, as the RBA is forced to cut earlier and harder than anywhere else. And then at the end of that, sort of into 2024, I think we just plonked straight back into kind of 2012, and we're in for another lost decade of wildly out of control mass immigration, made worse by a China restructure that this time is permanent rather than cyclical as it was in 2012 to 15. This time it will be a structural adjustment in China as it goes ex-growth, and then you can overlay that with geopolitics and deglobalization and other factors that mean the China story sort of ebbs away slowly but surely, and so Australia will be facing precisely the same conditions: falling national income with a permanent labour supply shock, and God help us if we actually end up with slightly stronger inflation with still weak wages, because I think we could have worse than a lost decade. We could have an appalling decade. But anyway, that's where I think we go back in time to where we were before the pandemic.
Excellent. Nice one, guys. So we've had a few comments coming through. So Jerry said, remember when everyone was saying inflation was transitory? So has this changed, and why has this changed?
Look, it has and it hasn't. It certainly changed in the US, where the labour market had a real structural hit to it. I think largely because they were a lot more libertarian about COVID, where they had minimal lockdowns, and a lot more protest against vaccines and things. And the end result there was just a mass retirement wave. And I'm guessing it was people who just thought, well, fuck it, I'm going to retire. Why would I go out and get sick? I don't need to. And so they lost like 5 million workers over COVID.
Well, and also a lot of people died there as well.
And a lot of people died. 1 million people, I think, died, or nearly. And so they had this structural gap in their labour market, which meant, wages really did take off in the US. And, probably exacerbated by some of the Trumpian border stuff over Mexico. And so they lost some of their cheap foreign labour as well. And so that became, a wage push inflation cycle in the US. So that was, erroneous to call that transitory.
But I think, though, David, as well, there's an element of this where you go, okay, there was this. It started off as a lot of supply chain problems, which we do think are genuinely transitory, and most of those are starting to come off already.
Yes.
And then that is exacerbated by then we had the Ukraine war breakout and more supply chain shocks and more and that merged into an energy shock as well. And so and again, we think the energy shock is again a transitory issue. And so you're talking about two transitory issues back to back. Now there's a fundamental issue: is does that actually create some self-sustaining? You get a change in attitude because you've just had that back to back, and then you start to. And so I guess my take is, look, the first cause was still transitory, absolutely. The second cause was still transitory, absolutely. Has that been enough to spark the inflation cycle and get things going? Maybe, but central banks have been pretty aggressive, and I think they're going to stomp on it. And I think we could easily see. As they stomp it in Australia, we haven't had the wages break out. And so what can easily happen is the first transitory thing finishes, the second transitory thing finishes, and the RBA smashed it, and it didn't need to smash it as hard as it did. And we end up with deflation.
Well, and that's right. And the only kind of sticky wicket in the Australian circumstance is this profits-led inflation business, and how much of that is gaming. And so, I don't. Who can say on that whether that would, if those two supply side shocks fell away, whether that would persist? I do not know.
And what David means,
but Australia has certainly never come near looking like it was going to have a sustained wage push inflation cycle the way it ended in the US, where they really did have a structural drop in their labour supply, which enabled Labor to finally catch a bid there after many years of being, squashed. And so one of the critical questions moving into the end of this cycle and the next one is will that ensure higher wage growth in the US into the next cycle? Because they really do have a wage gap there. And we're going to test how strong some of the, wage depressing structural factors are in the US. I suspect they will have stronger wage growth there. I don't think it'll be strong enough, but I think it'll be stronger than it was in the last cycle. Whereas in Australia, I think we've got a Buckley's chance of that unless we get away from the mass immigration model. So each economy is different. As Damo says, the transitory stuff was the two supply side shocks, and it then depended how that filtered through the various adjustments that other different economies were going through. So.
And sorry, just to add one extra point to that, from a company perspective, it does seem as if there's an idea that inflation gets embedded and people get used to it, and that's what drives future inflation. And there is certainly an element of companies that I've spoken to and people have spoken to about saying, well, I used to try and put through a 5% pay rise in prices, and everyone would scream blue murder, and then rather than doing another one the next year, I'd hold off for another year because it was just too much hassle, and people, and I'd lose sales, whatever. Whereas nowadays, I can put through a 5% price rise every 6 months, and nobody bats an eyelid because inflation. Everyone else is putting up prices, so I can put up prices even if I don't need to, and so. That's the part where if that is genuinely endemic now and people are just going to put up with price rises and keep doing it, and that's where David's saying, maybe we do need a recession to smash that so that when people put prices up 5%, they lose 10% of their sales and they go, oh, well, that was a mistake. I'll put the price back down again.
And what you're talking about there is inflation expectations, which did rise in the short term, but mostly haven't risen that much, at least in measured terms. There may be a gap between those and reality.
Well, but that's the part about buying quality company. We're trying to work out which companies are the quality companies at this point in the cycle. Which are the companies which have put through the price rises just because they could, and they can hold on to those price rises. So when things start to fall off, people just wear it, go, well, prices are up. I really need that product and it's good, and I don't have anywhere else to go, and so I just accept that. Versus other products, and I'll highlight the car industry as one in particular. They car manufacturers out there who used to produce 1 million cars a year, and then they can only produce 900,000, but they've got demand for 1 million, so they up their prices. And now they're all saying, the car companies are all going, oh yeah, we're all going to be a lot more disciplined, and we're not going to have stock, keep as much on stock, and we're going to keep prices higher, and we're going to keep making these great margins. And it was like, no, that ain't going to happen. There's too many car manufacturers out there, and guaranteed that are using these high prices, a Korean model or a Chinese model or a Japanese model will say, hey, I'll double my sales, and lower my prices and take advantage, and then everyone else has to chase. So that sort of high prices works when you've got oligopolies and a few players. When you've got quite a broad market and lots of competition, it doesn't work. And so the test will be which industries are the quality ones, or the ones that can keep the margins, and which ones aren't. So that's sort of the investment goal for the next year or two is really driving which are the ones that can and which ones can't.
Nice one. Thanks, guys. I hope Jerry gets some insight into that there. And we have a couple of comments from Alex R. So he's talking about the boom Australia had and asking, where did all the money go, and why are all the systems worse than they were 10 years ago? Does anyone want to comment on that?
Profits are up. So
well, profits went nuts, and there's 300 billion in extra savings, so that's a lot of it. Right.
Well, and there's a lot of this is offshore as well. Like a lot of it's owned by a lot of the big ones are owned by offshore companies, and so they plow a lot of money in.
Yeah. I mean, if he's talking about the COVID stimulus, then
right,
they went into profits and savings.
Oh, house prices.
Yeah, and house prices. Why is everything worse than it used to be? Well, that's a very long-winded answer.
But we'll save that for another podcast.
Yeah. But basically, the Australian political economy has gotten very dumb very fast, and there are all sorts of factors for why.
Well, actually, Dave, you got a post up just earlier on this week, didn't you? I thought that was quite. I'll try and summarise the key points, and you can correct me where I'm wrong. But basically, what you're saying is, it used to be you'd put out a policy idea, and then you debate it in public, and you'd come up, pros and cons, and eventually you come up with what the right things are, and that'd be what get rolled out. Whereas, since Kevin and his resources super tax, companies realise that they can muddy the waters and stir up problems and basically torpedo good policy ideas by just half truths and lies and various factors. And then basically the only way to get through good policy nowadays is to lie about saying you're not going to do it, and then all of a sudden surprise everyone by doing it, and then sort of put up with the fallout.
Yeah, pretty much. A lot more factors in it, including the internet. Actually, is a pretty critical factor. I think just in terms of fragmentation, and it has offered up a rich smorgasbord of channels to lie. So when you take those orders, the internet is a very murky pond. So I think it's contributed mightily to that. Yeah. Anyway, any more?
So Alex did make one other comment aligned to what you guys are talking about. He's saying he feels the Australian economy is going to fall off a cliff at the end of the financial year as more mortgage repayments stress homeowners, inflation, rent crisis, and the increased cost of living. So quick fire, yes or no question. Will we see our first tent city?
We're already seeing the small home expansion, which is basically, to me, this small home thing is, I think Leith said it, didn't it? It's basically it's basically the same as a caravan, but it doesn't have wheels. So
yeah, that's right. It's a downgraded caravan.
Yeah, so it's I guess it's one step up from a tent city, but certainly it's.
Yeah, I don't know. Like, I wouldn't expect the recession here to be so bad that we had. I'm only thinking unemployment getting to 6-7%. I'm not talking about 10 and 12, because the RBA now has a lot of ammunition to throw back out to unwind the hikes. They've got their mass immigration warm bodies coming in, which of course means in per capita terms it'll be crap, but in headline terms it's very supportive to growth. And the federal budget is in reasonable nick, and so if we really do have a demand hiccup, they'll be able to throw out some more stimulus. So I don't see it being a catastrophe, but I do see if the RBA keeps pushing a genuine endogenously produced recession, and that would be the first one of those we've had since 1990.
And the other thing is just to mention on the tent city point as well is the Australian housing market is very big, and there's lots of empty houses, and a lot of people have got spare rooms and stuff like that. It's an economic question about saying more kids stay at home for a little bit longer. Few people get an extra flatmate. All that you can actually tighten up, and there can be you don't need a lot to happen for the next few years of demand to sort of be sucked up into existing.
Yeah, and on the rental increases, if we have a recession, I would expect those to peter out as well, because if you're there's a pretty strong relationship between income growth and rental growth. Now, at the moment, one is decoupling from the other. But that can't go on forever.
Okay, nice one, guys. So now we've got our question of the week. This is for viewers to have some discussion in the comments section over the coming days. So the question for this week is, are markets delusional on Australia, or is Nucleus? So feel free to post your thoughts, engage with us and some of the other viewers over the coming days. Expect to see some interesting discussion there. And back over to you guys for the investment implications.
I think they've probably already rounded up actually on the outlook for 2023.
Yeah,
is pretty good. Pretty good wrap.
So.
Okay, nice one. Excellent. Well, thank you very much, guys. Thanks for putting on the show, and interesting discussion as always.
Thanks, Sam.
Thank you.
Excellent. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comment section below or send us an email to contact@nucleuswealth.com. Don't forget to like the video now, and if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. And if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content or subscribe on our homepage for our weekly Nucleus news and investment insights. We do put out a lot of other articles and videos in addition to this podcast, so you can see all those there. And of course, you can follow us on all major social media. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.